Good afternoon and welcome. I'm Hella Schwartz-Grossman, Marketing Manager at Worldox, and I'm pleased to welcome you to today's webinar. It is another session in our Legal Technology webinar series, usually scheduled for Fridays at 2 p.m. Eastern Time. We started this series as a means to introduce some of our partners and provide them with an opportunity to share the details about their application and technologies with you. Before we get started, just a few housekeeping items. The webinar will be recorded and the link will be emailed to you afterwards. Everyone is muted right now, but if you have questions, go ahead and type them into the GoToWebinar questions pane and we'll address questions at the end of the webinar. Our speaker today is John Dondey, Managing Director at Dimension Funding. As one of the nation's leading independent technology finance lenders for over 40 years, Dimension Funding provides innovative and flexible leasing and financing solutions created specifically for the legal technology market. As a legal technology financing expert, John has been instrumental in helping law firms of all sizes across the United States acquire the technology solutions that power their practices. On today's session, John will provide additional details on the many benefits of financing their legal technology solutions. Thank you in advance for attending for the attention you'll be giving this webinar today. And John, I'm handing it over to you.
Sure, thanks, Hella. Appreciate it. I wanted to thank Worldox for having me participate in the webinar, and thanks to everybody who's attending. Also wanted to wish everybody a safe and fun Thanksgiving holiday. I think we all need the break to relax and reflect, and hopefully look forward to improved 2021. So let's begin with a very quick overview of the state and how it relates to the topic at hand. There's no slide on this, but I thought it would be prudent just to give an overview of where we're at as a country. We always, as a company, do a lot of research, and I personally do a lot of research. I like to know what's going on. So anyway, the current economic crisis caused by COVID-19 has definitely caused an economic slowdown. Everybody knows that, with some sectors of the economy worse than others. Restaurant, entertainment, travel have all been devastated. Online retailers and tech companies have done pretty well for themselves. So interestingly enough, GDP grew by a huge 33.1% in the third quarter, which is, couldn't believe that, but it is true, bringing the economy back to only 3.5 percentage points below its pre-pandemic level. We'll see what happens in the fourth quarter. We know COVID's spiking a bit now. So anyway, consumer spending on durable goods soared to 82.2%, to a level that is now 11.9% above pre-pandemic. Business purchases of equipment surged 70.1%, housing 59.3%. Exports and imports leaped, but imports were more, which worsened our trade balance. No secret to that. The only negative notes were a 14.6% drop in non-residential building and a 4.5% decline in government spending, mostly related to the conclusion of the PPP payments to businesses. They expect fourth quarter growth to be only at around 2.5%. It may be more than that, it may be less. Everything's in the air right now. We'll have to see what happens with that. As far as the economy, we don't think it'll return to pre-pandemic levels, obviously, until next year, maybe mid next year, maybe late next year. And for anybody that's interested, that can be found in a recent Kiplinger report. Two factors that could boost GDP growth in the first half of 2021. First, it's likely that another large fiscal stimulus package will pass Congress sometime in the next 3 months. We can only hope it's sooner than that. The consumer savings rate declined 14.3 in September, but it's still well above the normal level of 7.5%. So for the year so far, through September, consumers have saved 17.5% of their disposable income. So there's cash saved up to spend, and businesses as well, the businesses that could definitely conserved. So expected GDP growth in 2020 on a whole will be probably around minus 3.5 to minus 4.5%. But they expect it to be in the 4 to 5% range for 2021. Let's get to law firms a little bit. Regarding impact of COVID-19 on U.S. law firms, just a quick summary before we delve into the rest of this presentation. As mentioned, along with most economic sectors in the U.S., COVID-19 has had adverse effects on the legal industry. There's no defined end to the crisis. Hopefully, we'll know more in the next couple months with the vaccine. Most U.S. law firms are adjusting with an ongoing struggle to serve their clients while trying to work hard to avoid going out of business like a lot of other folks have. In an effort to stay in business and maintain continuity, many law firms have trimmed their staff and budget. No surprise there. Many were forced or voluntarily closed their offices. Law firms and lawyers most impacted from this have been litigators and those working contingency cases. Law firms dealing in business mergers, acquisitions have also been negatively impacted. Contrarily, law firms and attorneys in bankruptcy, insurance, personal injury, not all personal injury, but a lot of personal injury firms, and employment sectors are for the most part doing decently. Regardless of a law firm's specialty, I think we can all agree that the legal industry has been irrevocably transformed digitally by the crisis. Current change practices of working remotely, video conferencing, marketing, and other reformed aspects of how law firms do business are expected to be permanently adopted, evolve in a post-COVID environment. There are positives to all this, believe it or not. The COVID-19 crisis has given law firms one great opportunity to deal with human performance issues. We saw that happening in the crisis after 2008, 9, 10. Same thing. Great opportunity for firms to look at excess capacity and make adjustments. Again, it kind of mimics what happened a few years back. Number 3, great opportunity for firms to assess their present client portfolio and switch to sectors and clients that represent opportunities due to COVID. We see law firms adjusting to that. And also segue into the next slide, 2 slides up, a great opportunity to review their technology infrastructure as to what they need now to function in the current and post-COVID-19 environment remotely and with employees coming back to offices, with a huge realization that acquiring the right technology is critical to retaining clients, maximizing their revenue, and maximizing smooth functionality of the firm. Yeah, let's move on here. Could quickly look at this slide. This will be a segue into the next one. Bear with me here just a second. As can be seen, according to an ABA recent tech report, 60% of law firms budget for their IT acquisitions. It's expected that in 2021, that number will rise significantly due to considerations of how law firms are now functioning. This is a direct result of what's going on with the pandemic, causing law firms to adopt technology much faster than previous years. Law firms that have already been utilizing technology, especially technology geared towards providing virtual legal services, have had more success during the pandemic than others. That has definitely given them an edge. Those others are realizing this, and they're busy reviewing, acquiring technology and scrambling to catch up for sure. Further, per a Clio Legal Trends report, 85% of firms that responded are using software to manage their practice. 79% of responding lawyers are also relying on cloud technology. Customers of law firms, as many know, are demanding their firm keep up with the Joneses in providing the needed technology for document transfer, to meet virtually, pay their bills, and other legal services that depend on technology.
John?
Yep.
John, I'm sorry to interrupt, but we got a comment that the others can only see the first slide.
Sure. Will you be sending that to me, or?
No, I
I
think we're good. I think we're good.
Oh,
Everybody can see. We're looking at the discussion points slide. We're all good.
Okay.
Okay.
All right.
Okay. We can address those afterward, or do you want to address them now?
No, we're good. It was more that we couldn't see the slides. We'll continue.
Okay. Okay. So the question is to continue. How can law firms afford this in a tough but hopefully recovering economy? With more law firms taking seriously IT budgeting, leasing and financing strategies have become critical in making the technology affordable and easy to acquire, rather than the firm to come up with a large amount of upfront cash. This partially alleviates capital budget constraints and fits a convenient payment into the firm's monthly operating budget. Further, leasing and financing arrangements can be tailored to a firm's ROI model with monthly, quarterly, semi-annual, annual payments, interest-only payments for the first 6 months, deferred payments, seasonal payments, and even other structures that a law firm we don't know about, a law firm may suggest to us that we can accommodate. And again, going through these slides, you can read these as, of course, as I'm going through it, and the presentation will be available to everybody. So go to the next slide here. Benefits of technology financing for law firms. Again, this slide covers a lot of it. First and foremost, many law firms don't realize what can be financed. And not all companies, and not to toot our horn, but not all companies can do this. Some can, some can't. But this is especially true for cloud-based subscription models, which can absolutely be financed. Most software publishers and vendors bill on an annual basis, some monthly, for cloud SaaS models, with the firm having to come up with those dollars every year on the yearly models, first year up front. This can all be financed. Further, there are many times cloud subscription, implementation, consulting, conversion, training, and other costs associated with the cloud model that has to be paid in advance. Those can also be included in financing. It alleviates funding technology that the law firm needs, whether it's a subscription model or if it's just a regular software model with licenses. So the subscription that we pay, and we'll speak for ourselves, we can pay it depending upon what the law firm and what the vendor have negotiated. We can pay the yearly subscription, or we could pay it all up front to the vendor. The whole point is the subscription can be all financed. Usually we match the term of the subscription to the term of the financing. So other financeable items, leasable items, again, mentioned software licenses, implementation, training, hardware. Of course, all hardware can be leased. And something new for us, we can finance managed services. And a lot of firms don't realize that, and a lot of the vendors who sell managed services don't realize that. We can pay the vendor up front for those, or we can pay them yearly, and those can be financed. Lease and finance terms can range from 12 to 72 months. Most of the time, it's 36 to 60 months, 90% of all transactions. As mentioned, graduated, deferred, interest only, monthly, quarterly, semi-annual, annual payments are all available. We just had a large law firm for a $560,000 transaction. They wanted annual payments with the first annual payment in advance. What that did is, because we're getting payments annually, that brought down the rate substantially. So let's move on. 8 reasons to finance equipment on hardware, software. Many firms are working with reduced capital budgets, which restrict acquiring necessary technology. This is overcoming budget limitations. Cost-effective leasing or financing arrangements place the expense more affordably in monthly operating budget, allowing the firm to proceed with their technology acquisition. Conserving working capital, this is super important with what's going on right now. The crisis has made working capital very scarce and protected asset for most firms. Technology, leasing, and financing arrangements not only protect the firm's precious working capital, but also keep bank lines intact, which are critical should the firm need those funds for any reason. Tax advantages, we'll cover section 179. That's applicable really to dollar buyout leases, which are considered capital leases, installment payments agreements, and bank loans. It doesn't, tax advantages, well, section 179 is applicable to that. Fair market value leases can be written off as a monthly operating expense, which we'll cover as well. Also, leasing and financing minimizes obsolescence. This is very true, especially for hardware, where firms don't want to get stuck with hardware after 12, 24, or 36 months. You can do a fair market value lease. The rate is extremely low, and that minimizes, they can turn the equipment back, get new equipment. And especially, I wouldn't say it's so applicable to software vendors. Software is upgradable every year, but really hardware, more applicable to that. Improves cash flow, obviously. A firm doesn't have to come up with a large capital expense, and they can use that money for other things. The monthly payments with us, and it should be with every lender, are fixed for the entire term. Don't want to get into floating payments, floating interest rates, and simplifies expansion. Firms right now, some firms are looking to buy other firms, or bring on talent from other firms, and having the cash on hand to do that rather than spending it on technology up front makes the cash readily available for the firm and gives them the flexibility to do that. So professional services, again, a lot of vendors and firms alike don't realize that professional services can be financed along with the implementation, whatever those are, whether they're consulting, whether they're training, they can be involved. So they can be included, excuse me. Tailored legal finance solutions. This is kind of self-explanatory. We went over financing the cloud. That can all be financed. We're really, and most vendors, most leasing companies, and especially technology leasing companies, we are not collateral lenders, and that's how we're able to do that. We rely on the credit of the firm or company rather than the collateral itself. We'll go to this. Key factors in evaluating your finance partner. This is really important. This is important for legal technology vendors, and it's also important for, of course, the law firm, extremely important for the firm. I'm going to go through a list. They're not all included in this slide. It was just too much to put on here. I'm going to send this to Worldox in a separate slide, which can be distributed to everybody. But anyway, sometimes it seems a daunting task, I would think, for firms and also vendors, that you guys get bombarded with sources, financing sources, and how in the heck do you figure out who's the best for you, who's the best for the legal technology vendor, who's the best for the firm. It's not as hard as it looks to determine that, but there are a good amount of questions to ask, but they're very simple questions. The first thing technology vendor or firm should do would be to pick 2 or 3 leasing finance companies that have a large presence within the legal market. There's plenty of companies outside the legal market. It's better to choose a specialist with the knowledge and experience in the market. Second, have those companies provide at least 5 legal technology vendor references. Vendors are a great barometer, just like Worldox and others. They're a great barometer of how law firms have been treated. They're the vendors' customers. Vendors can't afford to have customers mistreated. So legal technologies or vendors are a good barometer for other technology vendors to call on law firms to find out, who they've used and especially as references. Check them out, both. Ask if there are any prepayment penalties from the financing source. That's really important. Some sources charge excessive fees, and it's good to know that in order to make your decision. Ask if personal information and personal guarantees are required on established law firms. For the most part, we, along with a few others, we don't require it. Law firm, the D&B turns out okay, PayNet report turns out okay, we're good with that. The only time personal guarantees we get into are really with new firms or one or two or three personally owned firms. For the rest, no. So ask the financing source that. Ask if there are any blanket UCC filings. Many financing sources file blankets on the firm's assets, which really becomes a potential problem because your bank probably already has blanket filings on the firm's assets, so you can't do double blanket filings. Ask for their lease and finance documents. Read through them. Any company worth their weight in salt or gold will give you their documents to review and entertain any changes that you may have.
John, we lost your sound. John? John, can you hear us? We cannot hear you anymore. We lost your sound.
So while we're waiting, I think it is great that they offer so many different financing options because it gives people an ability to get into the Worldox product.
I'm sorry, we cannot hear you yet.
Microphone?
We can hear you now, John.
Now we can hear you.
Yeah, I replugged in the mic, but it was pretty good. But sorry, I don't know what happened there. Where did we lose each other? Can you hear me?
Yes, we can hear you. We did hear you for this part. It was toward the end of the next slide.
Let's see here. This slide right here?
Toward the end. Yes, toward the end of this one, just before you switched over to the next one.
Okay. So did you hear about how to choose a finance company?
We heard some of the recommendations you had to follow up, like check with them and get references and all of that from them.
Okay, good. I unplugged the headphone for some reason that shut down on me, so the sound won't be as good, but we'll do my best. You can hear me okay?
Yes, we can.
Okay, good. So I'll review a little bit. Ask if there's any blanket UCC filings on the firm. That's no good. Read through their lease and finance documents. Ask if they're DocuSign documents. And again, if no one heard it, ask the finance company, the leasing company, to actually give you their lease and finance documents for review. The vendor too. Vendor wants to see what they look like as well. So any company worth their weight in salt will give those to you. Ask about their pre-funding policy to vendors. Some will pre-fund vendors for whether it's software, hardware, whatnot, or if they do, they charge excessive amount of money for pre-funding. So ask them about that. Ask if there's any commitment fees. And again, Hella, I'll send you, this is not on this slide, but I'm going to send this to you after the presentation. So everybody can still hear me, correct?
Yes, we can.
Okay, good. Ask if there's any hidden or excessive fees in the lease or finance documents. Ask what their transaction range is. Maybe they only want to look at deals over $500,000, you know, and your firm or as a vendor, you're only selling deals from 20 to technology transactions, 20 to 100,000. So ask how quickly a transaction can be turned around by their credit department. You don't want to be waiting a week or 2 weeks for something to be credit decision. Should take less than a day on the smaller deals and a day or two for the larger transactions. So any commitment fees or contracts, you don't want those. I don't care how large or small the deal is, you don't want to be paying commitment fees. As a law firm and a vendor, if they see that, they're not going to do business with that financing source anymore. Again, ask if the rate is fixed or floating, and ask if there's evergreen clause on fair market value leases. Now, most companies on fair market value leases for hardware do have an evergreen clause. We have an evergreen clause. However, most evergreen clauses are for 1 year. So if you don't notify the leasing company, that lease automatically renews for 1 year. And this is really not good, but I've seen it on dollar buyout leases where it's supposed to revert to the firm at the end, but the leasing company keeps billing. You really need to check on that. With our evergreen clause, we can actually take it down to 1 month, which gives the firm time to upgrade to other equipment, keep the old equipment, upgrade to other equipment. So we're not sticklers on that. We're very easy. So once you receive answers to these questions, whether a vendor or a law firm, it would be that time to make a decision whether you're a legal technology vendor or a law firm or who you want to use for your financing. Go to the next slide. Section 179 benefits. This is really a self-explanatory slide, but I'm going to spend a little time on this. Most of you know what Section 179 is, but let's go through a brief explanation. A lot of folks that do know what it is think it's something out of reach and more complicated than it really is. It's not. This example shows that. I also want to say we do not give accounting advice. No leasing or finance source should. That should come from your CPA, whether it's, again, a vendor looking at Section 179 for themselves or a law firm. It really shouldn't come from us. But with that said, basically 179 allows businesses to deduct the full price of qualifying equipment or software purchased during that particular tax year. That means if you buy, lease, or finance, and we're not talking fair market value leases now, we're only talking dollar buyout capital leases, installment payment contracts, or loans. But if it's qualifying, you can deduct the full purchase price from the gross company income. Can be interpolated. The government created Section 179 to spur business growth, incentivize companies to acquire equipment, software, and other technology. Other than R&D tax credits, which is a whole nother discussion, Section 179 is one of the few government incentives that's available to small and medium-sized businesses. It's not necessarily designed for large companies. They use it, but really small and medium-sized companies. Just a second. In the past, before Section 179, companies, they wrote it off through graduated depreciation. So for 2020, Section 179, qualifying equipment technology, all costs can be written off up to $1,040,000. It is expected to continue into 2021 and beyond. None of us know what the government's going to do. with legislation, but right now it's intact. There are limits to Section 179, caps to the total amount. Again, $1,040,000 for 2020. Limits on the total amount of equipment purchased, which is $2,590,000 in 2020. And the deduction begins to phase out on a dollar-by-dollar basis after 2,590,000. It goes away after anybody's interested, $3,630,000. So who qualifies for Section 179? All businesses that purchase, finance, and/or lease new to be used business equipment during the tax year 2020, assuming they're less than the maximum being spent. So for 2020, again, $1,040,000 can be expensed. So people ask, what's the difference? Because you see depreciation on their bonus depreciation. What's the difference between the two? Bonus depreciation is usually used more for larger business spending more than the Section 179 spending cap. Also, businesses with a net loss are still qualified to deduct some of the costs of the equipment carry forward basis. Section 179 is applied first, then bonus depreciation is applied after that, unless the business has no taxable profit. So, and that's allowed to carry forward the loss to future years. The caveat with Section 179 is more than 50% has to be business use of the equipment or software or other asset. If it's less than that, you're going to have a hard time taking it. So I would pay attention to that for sure. The other thing I'll mention too is it applies to off-the-shelf software, but that's really a gray area. I would tell you that cloud, SaaS-based software models, most of the stuff that we lease, they're customizable, but they're off the shelf. They're still considered off the shelf. So from who I've talked to and all the law firms we lease, they do take advantage of this. So moving on. This is a conclusion to this section of the presentation. We have a little more to go. It can be said that over the last 25 years, more importantly this year, technology has been critical to the functionality of law firms, how they interact with their clients especially. Law firms that have more readily adopted technology over the years, of course, as mentioned before, were more prepared than firms that were not. Most importantly, firms that have addressed the affordability part of their IT budgets with regards to utilizing competitive leasing and financing arrangements to acquire much needed technology always have an edge over the other firms when it comes to keeping costs in check, attracting new clients, and obviously keeping existing clients, and attracting new talent to the firm. A lot of new talent wants the most up-to-date technology, and if they're very talented, they're going to look at that, and making sure the firm is running at maximum capacity. I'm going to do a quick comparison. Bank financing versus leasing. There's two slides to this. And it really is good for everybody to look at this, law firms to look at this. Dies. That's a misspelling there. Sorry about that. Bank rate fixed or dies, floats. Doesn't float with prime or other index. You want fixed rates, whether it's from a leasing source, financing source, or bank. You want fixed rates. Does bank require down payment? If so, how much? Getting technology kind of defeats the purpose, of having a restricted down payment. Does the bank require personal guarantees of the principals? This is an interesting one. In my years of doing this and financing to all kinds of firms and all size firms, many firms don't realize that when they started, the bank got blanket personal guarantees on the principals. I mean, I've run across 20, 30-year-old firms that the banks still have personal guarantees, blanket guarantees on the principals. Principals don't even realize that. If a firm can avoid signing personally, especially for technology,
avoid it, whether it's with their bank or financing source. Does the bank require all accounts to be kept there with minimum balances for loans? Look at that. What are the terms, loan terms? Does the bank require cash flow projections and client lists to loan money? Things are tightening up, and we've seen that. Is the bank set up to pre-fund your vendors, your legal technology vendors, in a timely manner? I've seen hassles with that. But if they do, what do they charge? Can the bank do add-ons to a lease or finance agreement during the loan, or is that set? Or do they have a minimum that they can do, that they won't go below? Does the bank provide leasing with a fair market value structure? We don't see that a whole lot with banks. We just pretty much see loans or credit lines. Does the bank have blanket liens, filings on the firm's assets, accounts receivable? Any good financing source is not going to, and again, most banks customarily do have blanket filings on the firm's assets. But if you're looking to finance technology, you really don't want a blanket on everything. And some lessors, finance companies will file a blanket again, which is in direct conflict with your bank. So look for a financing source that only files UCCs on the asset that's being leased or financed. And can the bank approve you with without asking for updated financial statements, and to what amount? Really good financing and leasing sources. Some of us can take this upwards of $400,000 or $500,000 on a 1 or 2 day approval without having financials. That's not always the case. I'm not going to say it is, but I would say in a majority of the cases that is the fact, with good financing sources and leasing sources. So let's talk about, just continue the conversation a little on banks. The first thing I want to say is firms should always have a good banking relationship. They should always have loans, loan money, or credit lines available, always. We're not trying to take the place of that. None of my competitors are trying to take the place of that. So banks do give competitive finance rates. And they already have a firm's financial statements on file. Depends if they keep asking for them or not. And the firm may represent the bank in various matters, and the firm may feel compelled to use the bank because of that. That's fine. Just a second. Disadvantages. Lines of credit with banks. They used to be done on a handshake. Again, we saw this happen in 2008, 9, 10, 11, 12. Things tightened up. Things are very tight right now. Banks are expecting some very, very large, and already seeing very large defaults. Some in the legal community, many outside the legal community, not as easy to get money through the banks, firms were used to doing, especially with established relationships. They're tightening up on all those requirements you see. A lot of banks don't want to touch software, especially SaaS, cloud-based software. They may do capital leases or financing only, no fair market value, we mentioned that. And a lot of banks are having financial difficulties closing branches. You can't readily access them as you could before. I know around us, a lot of branches from different banks have closed. My wife in particular, and she's still working. She's a top producer, thank goodness. But her bank has closed branches, and many of those folks are getting out of the business. So something really important to look at. And this is a final review as far as some of the things that we went over. Having leasing and financing for your technology acquisitions preserves those bank lines, which firms should have. They should always maintain those. You should look at a leasing and financing source that has bank competitive rates. May not be as low as the bank, but we out here may not ask for personal guarantees. We may not file blanket UCCs. We may be able to get the deal approved in 1 day and pre-fund your vendor same day. We don't ask for compensating balance requirements. No blanket liens as mentioned, and 100% of the technology investment can be financed. Everything, including all professional services. protection from obsolescence, and matching ROI, return on investment to the firm, and structuring leasing and financing arrangements match what the firm needs based on their cash flow and other factors. And leasing to new firms. We are seeing some firms branch off. Some folks branch off. They have customers where they're getting into areas where maybe COVID has caused more business to be had. So leasing and financing source should be able to finance new firms, especially attorneys that have been established and that have a great track record. I know, Helen, you mentioned a lot of stuff about dimension funding. I'll mention a couple other things about us. And in just a second. So Dimension is an interesting company, been in business since 1978. We are one of the largest independent technology leasing and finance companies in the United States. We're not owned by a bank. We have our own money. Our major concentration is in technology. My group, as Helen mentioned, we handle most of our businesses in legal, IT. We have excellent relationships with vendors like Worldox and their partners, other vendors, and we do all size law firms. It doesn't matter if it's a single practitioner all the way up to a multinational firm, and we financed all of them. Facilities management companies, legal departments. We don't see a lot of that business anymore, but we still do it. And myself and Dean Morrison, who's been with me for a long time in this business. Just as a quick history, we ran the whole legal group for American Express Business Finance for 7 years, produced quite a bit of business. We have under our belt over 2,000 law firms that we provided leasing and financing. So at this time, I wanted to thank everybody for being on. Hope I did run over, and I'm sorry about the audio. I'm not sure what happened, but I borrowed headphones from Dean, and maybe they bugged out on us, so don't know. But here to answer any questions that anybody has, and spend as much time as you want.
John, thank you for the overview of everything that you can provide to the customers. One question that came in is we have like several customers are interested in moving forward now with the implementation of Worldox, but they have budget issues preventing them to do so now. How can your financing programs be helpful to a firm that may want to move forward in 2020 but not make payments until 2021?
Sure, and that's a great question. We do have in place, for creditworthy firms, most of them are going to be creditworthy, 90-day deferred rates where we book the transaction now, pay the vendor now, whether it's a lease or finance agreement, and they don't make payments for 90 days. We can also go up to 180 days, though that involves a little bit more contact payments, but contact payments, depending on the size of the deal, a couple $100 a month. So we do 3 months deferred and then 3 months of contact payments, just so the firm knows there is a lease or finance agreement with us. But yes, that's a way to circumvent that, where there's no payments made for 90 to 180 days.
So, John, I think it's first of all great that, a lot of times we have customers and the initial cost to purchase Worldox or even just to get into cloud, involves not only the software cost, but also the implementation, and sometimes there's conversion if they're coming from another system. And I know you touched on this, but first of all, I assume people can finance all of that instead of just the software. And what are the terms that they can, can they finance that for a year or for how long?
Sure, no, that's a great question. So let's just take we'll take a cloud SaaS model. We'll separate it from licenses for a minute. Under cloud SaaS model, let's say it's a 3-year subscription. We'll finance that for 3 years. 2-year subscription, 2 years, 1-year subscription, 1 year. If it's a 4-year, 5-year subscription and they want to do that for less time, you can do that as well. We just can't do a 2 or 3-year subscription for 5 years. So for 4 years, we try to match the subscription to the the finance term. So everything can be included: implementation, training, professional services. The cleanest way to do that is to we start the contract. It's called early commencement, and again, we can tag a 90, 120, 150, 180 day deferral on that while the implementation's being done. And all implementation charges for that are also included in the financing. So we go ahead and pay the vendor for that, you guys, if it's Worldox or your partner. The customer starts making their regular payments, but on a deferral, they don't have to make the regular payments. We usually pay for it's a 3-year subscription, 3 years up front, plus all training, implementation, conversion, whatnot. That answers the question.
Yes, that does answer it.
Let's see, what else do we have of questions? Someone asked, when financing alternatives, it is the perception that personal credit information of the partners is required for deal approval. Do you have any additional insights as to how that works with dimension funding?
Yes. If there's a firm, it doesn't matter if it's 5, 6, 7, 8, 9, 10 partners or shareholders, we don't ask for personal information up front. If they're in business, I'm going to use a very loose line in the sand of 5 years, but we've gone under that with no personal information. 5 years in business, we either get it done without personal information or guarantees, or we don't get it done. Other than 1 or 2 or maybe a 3-person law firm, 3 shareholders, even then I've seen us get it done. We run a Dun & Bradstreet report. If that's clean and the paynet is clean and the firm's established, even if it's a smaller firm, we're not going to ask for personal information or personal guarantees. If we can't find any credit information on the firm at all, we may ask for a financial statement or a tax return on the firm just to try to get them done without guarantees. But I can honestly say that firms that are run through here that we provide financing for, over 95% are not with personal guarantees or personal information. But the ones that we do ask for it are normally new firms that have spun off from another firm or a very, very small firm. Hope that answers that question.
Yes, it does.
What
else?
The other thing I wanted to say about personal guarantees, I won't say they're worthless is a bad word, but if a firm's going out of business, and even if we have personal guarantees, those attorneys are probably going to declare personal bankruptcy anyway. So it's impossible for us to collect anyway, and that's why we don't look at getting personal guarantees or personal information. So.
Okay. All right. Thank you very much, John.
Sure.
Let's see. Oh, somebody asked, what are the current interest rates in the marketplace and also with dimension funding?
Sure. Again, interest rates vary. You want to look for a lender, and I can speak for us. We have programs where we can get down. Current prime right now, so everyone knows, is 3.25%. For all around. Can you get a car loan for very cheap rate or or get a home loan for a very low rate, yeah. Commercial business is a different story. Again, banks are expecting and already seeing a bunch of bankruptcies. This is going to continue for years. So, that 3.25 rate is usually reserved for firms or companies that are just much larger, probably over 50 million in business. We don't see that rate being offered to the small and medium-sized businesses. In fact, again, I'll bring up my wife. She's a commercial loan officer. She doesn't share too much with me because she's in this area, even though we do business nationally. She has her own law firm clients. But most of the time, it's prime plus 1 to prime plus 2. And we can match up to those rates, prime plus 1, prime plus 2, without getting personal information, personal guarantees, UCCs. I had a law firm out in California recently. It's about a $220,000 transaction. We approved them without guarantees. Our rate was about 2 points higher than the bank. And they showed me what the bank rate was. And I said, well, according to your Dun & Bradstreet report, your partner signed personally. He goes, no way. I go, do me a favor. This was the administrator. Call your bank. Find out if they have blanket guarantees. And he got back to me the next day and says, I can't believe it. There's blanket personal guarantees. They won't waive them. We're going to pay the extra for you guys and go with you because they didn't have to sign personally. But to answer your question, we can take a little bit more money up front. We can get rates down to the 3.25. With a little more money up front. Normal rates are in the 4s and 5s for larger deals over $100,000. And under 100,000, they're in the 5s and 6s. That answers everybody's question.
Okay, all right. Thank you, John. It looks like we answered everybody's questions. Any last comments that you would like to add to the session today?
No, other than everybody keep their head up. We're going to get out of this, and everybody's going to do well, hopefully in 6 months. But until that time, everybody just keep working hard, moving forward.
All right. Thank you, John, very much for sharing all the information about Dimension Funding with us today. As mentioned, we are going to post a recording of this webinar, so anyone unable to attend, they will still have a chance to see it. To anyone who did attend today, thank you very much. And just a reminder, we do have our regular Worldox webinar, technology webinar series session scheduled for Fridays at 2 p.m. Eastern. And we do hope you will join us for any of the upcoming sessions. In addition, we do have a special webinar scheduled for next week on Tuesday, November 17th, also at 2 p.m. Eastern. And we will be discussing Worldox, Office 365, and Azure. And you can register for any of the upcoming webinars on our website. So thank you again, John, and wish everybody a happy weekend and see you next time.
Absolutely. Thanks again. Take care.